Alright, good morning guys. Today we're going to be going over the Chewy stock earnings, and I'm also going to look at the ASST, which that run-up's been crazy. I've been keeping an eye on it for the last month, and the news finally broke, and it's breaking all the short barriers, so we'll get into that as well. But for now, let's check out the Chewy earnings report. I already took a little glance at it. I have some notes I want to go over. The revenue growth grew 8.6% year over year to 3.1 billion, which beat guidance. But one thing that I'm really looking at is the GAAP net income went down from 299 million, and the earnings per share at 68 cents to only 62 million and 14 cents. And that's I'm pretty sure it's due to they got a tax relief last year, which made it look way better at the valuation, and everything kind of dropped. The sales have looked good, and the customer expansion was really well done. There's a lot of good things to look forward to here. It's just tough to give it this valuation, especially with the guidance being so bad and the GAAP short falling to a level which I don't think anyone really expected it to go that low after everything that was kind of promised, if that makes sense. And I think there's still there's still room for a breakout to 48, because that was kind of the resistance at 42. But it's still at a it's at a breakout threshold, because the relative strength is still at 80, so anything could happen. That's why I'm going to listen to this. If you want, you could go over this, and I kind of went over it already. There's not too much to see there. I'm still playing the music, so nothing we're missing out on. Of course, as you know, with Chewy, it has a high valuation, but it kind of gets grouped into those meme stocks with like GameStop and all that. So you're kind of expecting that from the start. And if you know what you think you're doing here, I think there is still room to make good timing and everything on it. You just gotta keep a close eye on it. I haven't looked at the presentation yet. I'm gonna watch it as they go, kinda, with the show. Yeah, I already read this. I'm surprised it dropped so much. Of course, it's just some money makers making all the moves, but I was surprised that it went down that much, because it felt like it wasn't too bad of an earnings call, in my personal opinion. So that's kind of where I'm at right now. If you guys got any comments or anything, make sure you drop them in the chat, and I will be responding to them. But yeah.
Appreciate his dedication to Chewy as he takes on this expanded role while we continue to search for a permanent CFO. Our earnings release, which was filed with the SEC earlier today, has been posted to the Investor Relations section of our website. In addition to the earnings release, a presentation summarizing our results is also available on our website at investor.chewy.com. On our call today, we will be making forward-looking statements, including statements concerning Chewy's financial results and performance, industry trends, strategic initiatives, share repurchase program, and the environment in which we operate. Such statements are considered forward-looking statements under the Private Securities Litigation Reform Act of 1995. These statements involve certain risks, uncertainties, and other factors that could cause actual results to differ materially from our forward-looking statements. We encourage you to review our SEC filings, including the section titled Risk Factors, in our most recent Form 10-K for a discussion of these risks. Reported results should not be considered an indication of future performance. Also, note that the forward-looking statements on this call are based on information available to us as of today's date. We assume no obligation to update any forward-looking statements except as required by law. Also, during this call, we will discuss certain non-GAAP financial measures. Reconciliations of these non-GAAP items to the most directly comparable GAAP financial measures are provided on our Investor Relations website and in our earnings release. These non-GAAP measures are not intended as a substitute for GAAP results. Additionally, unless otherwise stated, all comparisons discussed on today's call will be against the comparable period of fiscal year 2024. Finally, this call in its entirety is being webcast on our Investor Relations website. A replay of the audio webcast will also be available on our Investor Relations website shortly. And with that, I'd like to turn the call over to Sumit.
Thanks, Natalie, and good morning, everyone. Q2 net sales grew by nearly 9% year-over-year to $3.1 billion, exceeding the high end of our guidance range. Moreover, against an industry backdrop of low to mid-single-digit growth, our Q2 performance demonstrates a clear share gain outcome. Strength of our AutoShip program in categories such as consumables and health anchored Q2 net sales performance. Second quarter AutoShip customer sales of $2.58 billion represented 83% of our Q2 net sales, reaching a new record high for the company. Growth in AutoShip customer sales once again outpaced overall top-line growth, increasing by nearly 15% in Q2. We are also pleased to see the continued strength within our hard goods business, which grew over 15% in the second quarter, primarily on the back of structural volume growth. And finally, a rapidly strengthening Chewy Plus program exceeded our expectations in the second quarter. I will comment more on our progress with this program in a moment. Moving to customers, we ended the second quarter with 20.9 million active customers, reflecting 4.5% year-over-year growth.
5% up.
Importantly, the strength and quality of our new customers continue to improve. New customer NSPAC for the Q2 2025 cohort strengthened quarter over quarter and is trending mid-single digits higher on a year-over-year basis relative to the comparable Q2 2024 cohort. For total Chewy, we continued to expand customer share of wallet in the quarter, with NSPAC reaching $591, representing 4.6% year-over-year growth. Moving down the P&L to profitability, gross margin reached 30.4% in the quarter, expanding on both a sequential and year-over-year basis by nearly 80 and 90 basis points, respectively. For Q2, main drivers of gross margin were both our fast-growing sponsored ads business and favorable mix into premium categories. Pricing and promotion remained rational and did not have a material impact on gross margins in the second quarter. Continuing on the topic of profitability, we generated $183.3 million of adjusted EBITDA in the quarter, representing a 5.9% margin and a year-over-year increase of over 80 basis points. We also generated nearly $106 million of free cash flow in the quarter.
There we go.
Our robust profitability and compelling free cash flow generation enabled us to not only invest in our strategic growth initiatives, but also return meaningful capital to shareholders, as reflected by the nearly $125 million we deployed towards share repurchases in the quarter. Now, I would like to provide an update on some of Chewy's strategic initiatives. The Chewy Vet Care, or CVC network, continues to outperform relative to expectations in terms of demand generation and driving broader ecosystem benefits. We are consistently observing that CVC customers drive both the highest and fastest NSPAC curves for Chewy. Additionally, we remain on track to open 8 to 10 new practices in fiscal year 2025 to reach a total count approaching 20 by year end, and we look forward to keeping you updated on our progress. Shifting gears, let's talk about Chewy Plus, our paid membership program. As a reminder, today Chewy Plus members receive the following benefits: free shipping on all orders, 5% rewards to redeem on future orders, limited time seasonally relevant member exclusive offers, and a 30-day free trial period. At the end of the free trial period, members pay an introductory price of $49 per year and convert to paid members.
There you go. Starting to see
As
some
I
movement.
shared in my remarks earlier, the Chewy Plus membership program is rapidly strengthening, indicating a strong product market fit. In the month of July, roughly 3% of Chewy's total monthly sales were to Chewy Plus members. Importantly, we are observing strong incrementality in spend, NSPAC, and positive contribution profit per customer across Chewy Plus customers compared to non-members. Furthermore, other key leading indicators of success are promising. These customers are buying at a higher frequency and attaching a higher number of products to their orders. Additionally, we are observing incremental Autoship adoption and greater mobile app usage from Chewy Plus members relative to non-members. All of this is leading to both higher as well as accelerated NSPAC curves for Chewy Plus customers compared to non-members, which in turn is contributing positively to Chewy's net sales flywheel. As we exit this year, we expect approximately mid-single-digit percentage of our net sales to go through the Chewy Plus program. Further, we expect the program to generate positive gross profit dollars in fiscal 2025, though at a gross margin rate below Chewy overall, reflecting both the ramp that we anticipate in the second half of this year and the mix of paid versus free trial members.
I heard ramp.
As we scale, we will remain disciplined in evaluating the program structure, including pricing and member benefits. Moving on, now let's talk about Chewy private brands. I am excited to share that in August, we launched Get Real, our new Chewy exclusive private brand of healthy, fresh dog food. The fresh and frozen segment represents a fast-growing TAM fueled by trends of humanization and premiumization in pet. Consumers believe that their pets deserve fresh and nutritious food, leading to longevity and an overall higher quality of life for their beloved pets. Get Real, a new line of minimally processed fresh dog food available only at Chewy, comes in 3 different pup-approved recipes, including chicken and Brussels sprouts, beef and sweet potato, and turkey and cranberry, all available as both full meals and meal toppers, made with 10 or fewer ingredients, plus vitamins and minerals.
We care about.
Additionally, this premium product is delivered to your doorstep in pre-portioned, ready-to-serve meals. Just thaw and serve. Although the product has only been in market a few weeks, customer reception is strong. Customers are pleased with the palatability, quality, and overall experience, which includes shopping, delivery, and consumption. I am also pleased to share that we have already built up sufficient capacity through 2028 to support our growth in the fresh frozen segment broadly, both for Get Real and for our national brand partners, while remaining very much at the lower end of our previously set CapEx guidance range of between 1.5% to 2% of net sales.
Talking points.
With the capital investment behind us, we are now in process of scaling to a national footprint by leveraging our existing fulfillment center topology. By the end of 2025, we expect to be ready to deliver a majority of our fresh food offering to customers within a 1-day transit time. Furthermore, Get Real is exclusively an Autoship subscription business that results in high gross profit per unit at scale, supporting both broad leverage across our operational infrastructure and our aspiration of becoming a leading profitable player in the fresh and frozen segment. While still early, we are pleased with the launch of this product and the positive response from our customers.
Chewy about to kill the competition.
Beyond Get Real, we are working on bringing other Chewy-branded product innovation to market in the second half of 2025,
I think it's going to be
and I look forward to keeping you updated
if you're holding for a long time, you're going to be fine. I'm not sure about
Before I turn the call over to Will, I would like to leave you with a few closing thoughts. The first half of 2025 has been an exciting and productive period for Chewy, reflecting the strength of our differentiated value proposition and the momentum across our business. Looking ahead, we expect the second half of the year to be even more dynamic given the evolving macro. As many retailers prepare to pass tariff-related costs on to customers, we believe Chewy is well positioned to mitigate these pressures. Our higher mix of consumables and health and proactive investments in onshoring incremental discretionary inventory provide meaningful safeguards. These actions will help deliver a superior customer experience by selectively evaluating pricing while protecting product margins. Additionally, instead of absorbing these pressures, we plan to lean into growth by investing behind the expansion of programs like Chewy Plus and our private brands.
Yes, sir.
Customers are embracing these initiatives for their compelling value proposition, and we are equally encouraged by their strong return on investment. Overall, we see the second half of 2025 as an opportunity to further accelerate market share gains in the U.S. and position Chewy for even greater long-term success.
But it will definitely.
With that, I will turn the call over.
Probably by the end of the decade, for sure.
Thank you, Sumit. And thank you all for joining us
today. This earnings wasn't even bad. It's
Let's
just
review our financial results and outlook.
It looks bad because of the gap.
Second quarter net sales
dropping so high. But that's just because of the tax implications from last year.
Exceeding the high end
so it's not even bad.
Q2 guidance range we provided last quarter.
So I wouldn't be worried about this overreaction.
We reported
this morning.
second quarter gross margin of 30.4%, representing approximately 90 basis points of margin expansion year over year. Shifting to
I
operating
don't see them losing momentum. They're launching their businesses and it's
exactly. I think and related taxes,
pet care, it's only going to get bigger and bigger in the U.S., especially everyone I know is getting new pets. Everyone I know cares more about their pets than actual people.
Approximately 30 basis points year over year.
I think it's a great business model, and they're going to keep growing, especially as we already saw this quarter. The customer expansion, so I'm not too worried at all. And if they could keep growing the customer base, it's only going to be better and better.
Processing costs, primarily within hard goods, to ensure we have
the right Chewy
assortment
at your house. Do you have any pets?
As we head into the peak holiday periods, while also allowing us to mitigate impact from tariffs in 2025. Additionally, a smaller contribution came from increases in wage and benefit costs within the period. Importantly, we believe these increases are primarily temporary in nature, and we continue to expect to
People
deliver
are not having kids, we're getting more pets. They want shit delivered to it.
Exactly.
I've always been saying that. Kids are a hassle. You have kids, they're running around, they're screaming.
A
dog. He's your best friend. Just sits there whenever you want to go. I remember there was I'm from Poland, and there was a funny story. My uncle tried leaving our dog, like not our dog, but his dog, like a couple villages over, because he lived in like a farmland, and because he didn't want the dog anymore, he couldn't like take care of it. And by the next morning, the dog was already back at his doorstep. So like, people are always gonna love pets. It's hard to not be attached to pets and stuff. Used to, no pets anymore, only kids. No kidding, that sounds pretty bad.
Which reflects 80 basis points of year-over-year margin expansion.
At least you get to invest as you want.
Cash flow of $105.9 million
and do what you want, as long as the wife doesn't know, obviously.
$133.9 million of net cash provided by operating activities and $28 million of capital expenditures. For full year 2025, we reiterate our expectation to convert approximately 80% of adjusted EBITDA to free cash flow, and CapEx will be at the low end of our previously stated range of 1.5 to 2%.
I'm surprised it's not moving much. There's only like 500,000 shares traded in the pre-market
for a total of approximately $125 million. At the end of Q2, we had $359.8 million of remaining capacity under our existing program for future repurchases. We ended the quarter with approximately $592 million in cash and cash equivalents, and we remain debt-free with an overall liquidity position of approximately $1.4 billion. Now I'd like to discuss our third quarter and full year 2025 outlook. We expect third quarter 2025 net sales of between $3.07 and $3.1 billion, or approximately 7 to 8% year-over-year growth. And we are raising and narrowing our full year 2025 net sales outlook to between $12.5 and $12.6 billion, or approximately 7 to 8% year-over-year growth when adjusted to exclude the impact of the 53rd week in fiscal year 2024. This represents a $175 million increase to the midpoint of our guidance range. Moving to profitability guidance, we are maintaining our full year 2025 adjusted EBITDA margin outlook.
I wonder what analysts are going to get the questionnaire, so I'll probably listen to a couple of those.
As Sumit shared in his remarks, we believe it is prudent to remain on the offense in the second half of 2025 and invest to strengthen Chewy's share position in the pet category. The midpoint of our guidance range indicates 75 basis points of adjusted EBITDA margin expansion year-over-year. Furthermore, at the midpoint of our 2025 net sales and adjusted EBITDA margin guidance ranges, we expect to deliver approximately 15% adjusted EBITDA flow-through for the year, in line with our previously stated long-term target.
5,000 shares and it moved it that much.
Importantly, and consistent with our comments last quarter, we continue to expect approximately 60% of our adjusted EBITDA margin expansion to be driven by improvements in gross margin, confirming that we expect to continue to deliver healthy gross margin expansion year-over-year in fiscal 2025, with Q2 being the high point for the year. And finally, we also expect Q3 adjusted diluted earnings per share in the range of 28 to 33 cents. For the full year 2025, we are also reiterating our previously stated expectations related to share-based compensation expense, including related taxes of approximately $315 million, and weighted average diluted shares outstanding of approximately 430 million. 2025 net interest income of approximately 25 to 30 million, and we continue to expect our effective tax rate to be between 20 to 22% for 2025. Before we open the call for questions, I'd like to reiterate that our strong Q2 results underscore the continued momentum in the business and strength of execution by our Chewy team members. We believe that Chewy remains well positioned to continue to deliver share-gaining growth and enhance shareholder value. With that, I will turn the call over to the operator for questions.
The fact that they're debt-free is insane.
We will now begin the question and answer session. As a reminder, if you would like to ask a question today, please do so now by pressing star followed by the number 1 on your telephone keypad. If you change your mind or you feel like your question has already been answered, you can press star followed by 2 to withdraw yourself from the queue.
It took a while.
Our first question today comes from Doug Anmuth with JP Morgan.
They still, I think they still have what's it called, gross debt, but
thanks so much for taking the questions.
It's on a net debt basis.
More about the investments that are required in the back.
They have enough
and
to pay it off whenever.
2026, just as you lean into
and there's no real debt.
A little bit more detail on those, and then also just how are you promoting and increasing awareness of some
people
of the
don't
new
understand
offerings,
how insane that
like
is.
Chewy
a $12 billion business debt free. Yeah, no, that's the thing.
Hey, Doug, good morning. So
the PE looks high, but it's realistically low when you consider all the facts and
as you know, we have a very large base of customers.
It
continues to grow. This customer base is sticky.
There's a lot of growth in this business.
Like
that's the thing that I don't think people are realizing yet.
To enhance the process
and
of discoverability.
The gross debt to equity ratio is
explore, discover, and
it's
then
the lowest it's ever been, and the net debt is pretty much zero. So for a business that started out, I remember when it was when I like first started investing during COVID,
so far we have not spent
that was one of the big things that brought it down. I feel like
and we don't
all the way down to 15, which was awesome time to buy.
Really good participation of existing Chewy members
now it's all the way at 38,
Plus members, so the
which is still too low. I was really expecting today to be a day we go to like 48.
Exposure is being provided by on-site and funnel.
You can't win them all. That's the
now
that's the
coming
game.
to Get Real, our approach is very similar. Large audience. We have what we believe. Really good recognition of what looks like premium cohorts.
Then why is it down?
For us?
I was saying it earlier. I think it's down because of the non-GAAP numbers. They look really bad. When you look at it, how much did it drop by? Let me go back to the spreadsheet I got here. It dropped from 300 million to 62 million. And the earnings per share dropped about 50 cents as well. And it shows that the tax benefit from last year, it had
from that standpoint, the inputs that we've been
had a big drop on it, and the net margin shrunk a little bit, but it wasn't too much.
Exactly where we want it.
I think a big issue is the class action lawsuit that just launched last week. I did see that.
There are many products out there that are priced much higher. And
it's tough to say with those because we've seen like Google and stuff, how those will drop the stock by 10%. But
to the consumer. Third, if you explore this product in the way that
I feel like they should have meant. They couldn't have mentioned it. They didn't have to.
We've built a curated experience.
I feel like those come up for every company.
That allows customers
it usually comes up, brings the price down, and then a month later the price is skyrocketing up. So I wouldn't be too worried about the lawsuit at all.
And that will be our strategy moving forward as well.
I think we just keep watching
so from that standpoint,
listen to some questions.
You shouldn't expect us to lean very heavily in marketing dollars. Currently, we're
someone will ask a question about it for sure.
Offer.
That's what I was
Get Real
thinking
customers,
about.
The fresh and frozen customers,
no point,
high NSPAC customers.
You're
looking at plus $2,500 spend for full meal customers, and running into the high hundreds for topper customers.
The volume's not high on the drop though.
Really propense towards health
because
and wellness.
I'm invested in ASST yesterday, and
we see
the drop was insane when the SpaceX news came out. But this news isn't. It's not anyone selling really.
The fact that we've already spent the money in building
it looks worse. I think when market opens, it'll recover really well.
Essentially make you
overall, if the users are up, then we should exactly. I was saying, if it keeps growing year over year, the customer base, there'll be no problem, and you're only going to be able to get more and more out of each customer because people are getting more and more pets.
But broadly speaking,
and they care more about their pets than anything else.
High sales, high margin verticals, and we're excited to be finally leaning into them and driving even stronger NSPAC consolidation.
Great. Thank you.
Thank you.
Yeah,
our
users
next question
will always
comes
be
from
up.
Nathan Feather with Morgan Stanley.
Most people get
Please go ahead, Nathan.
It's the same thing as like Amazon. When you think of Amazon, it started out like, oh, no one's gonna want you to ship stuff to their house. That's stupid. I can just go to the store and buy it. It's gonna be the same thing. People are only gonna get lazier and lazier. It's very convenient service. It's a good service, and it's been made really well by the CEO and everyone else. Now they have the opportunity to
Nathan, let me provide broader commentary on SG&A and also
bundle the vet services, health services, and food.
First of all, as we discussed on the
call, it's a huge win.
Roughly 60%
I agree
of our adjusted EBITDA
that
expansion to
the vet services are being really overlooked in this earnings call.
So we do expect to deliver SG&A leverage.
I think that's one of the biggest things
and by inference
that
of
could
our
happen
first half
here.
Performance, you can expect that leverage will come in the back.
The market isn't really pricing it into the stock right now.
Yes, the amount of
a smart investment would be a portfolio of Chewy plus Amazon. Yeah, that's not a bad idea, actually.
I think that's the
I've always thought Amazon could buy out Chewy for like $50 billion
elaborate on that a bit.
And just kind of dominate everything.
Flow in cycles a bit.
How much would that mean for?
As we elaborated in our Capital Markets Day in December 23, we set a target of roughly 200 basis points to deliver. So far, roughly 2 years out, we've already delivered 100 basis points or 50% of that target. the majority of that leverage has come from us ramping 4 fulfillment sites, which are automated 2G sites, and roughly flowing, 40+% of the volume through these states of automation within the company, right? By Q2 of next year, we expect nearly 50% of our volume will be automated, especially as Houston ramps up. Now, let me talk about the specifics in the quarter. So there's a couple of things that are happening in the quarter.
If it was bought out for
right? So
$50 billion, then it'd be about $115 share price.
And it takes roughly 6 months for a Gen 2 facility to ramp sufficiently to start delivering leverage. And I went back and checked my notes.
You guys, as investors, would you guys take that? 114, 15 per share.
So this facility is ramping well. It's ramping as expected, but it takes about 6 months for a Gen 2 facility to ramp for it to deliver sufficient leverage. As such, we do expect to see leverage out of the facility.
Because it's going to be a $50 billion company in the next few years.
That's going on in
or you could just take the quick payout now.
Look,
because Amazon could definitely just swoop in and buy it.
In 2025, and as you can infer, we're growing purely on the basis of units. It's structural growth, which is comping first half growth where we had pricing benefit. And so what you'll see is that SG&A, that is a variable cost element, right, will essentially be enhanced the faster we grow on the basis of units. But that's a high quality problem to have because it builds density. It allows us to extract more cost out and get the economies of scale as our facilities fully ramp up. So again, that's a transitory thing, and we expect this to be a lot easier and better as we step out from 25 into 26. Now let's talk about the one-time elements. So we picked up incremental inventory in hard goods because, as you can see from the commentary in the market, prices are expected to rise in the back half of the year, right? And so we wanted to both shore up the inventory to deliver an immaculate customer experience from an in-stock point of view. But you know what? We might invest in price, right? We may invest in price to take share while everybody else is raising price. Chewy becomes, another destination for pet parents to really extract the maximum value. So, temporarily,
there we go. He's bringing into the customer experience is everything with this type of business. And keeping customers and growing customer base. If you could keep doing that, then that's what's really going to drive the price of the stock over time. And we've only seen the customer expansion every year.
That we talked about in the
so I'm glad you brought that up. We're covering a little bit
and
right there.
Which was a smaller, element, which is sometimes cyclical, and that was about $2 to $3 million per se. So, the important takeaway is that you can expect SG&A costs to moderate in the back half of the year.
What are your thoughts on most of the growth on the stock was on the expansion of the market in Canada last year?
Thank you.
Of course, there's going to be growth in different markets, and that's the thing. It's only going to continue to grow in different markets. It doesn't have to be every person in the U.S. has it if it's international business. And,
hey everyone, good morning. Thanks for the questions. Just
only
squeeze a few together here.
And
maybe we could just start on the Q2 gross margin improvement. You mentioned the premium products. That seemed like somewhat of a shift. Also, maybe talking about some of this price investment in the back half. So can you unpack all that for us and how we should think about the drivers of gross margin expansion in Q3 and Q4? And then also just on the new OpEx investments, can you help us understand is all of this fully in your control and making decisions to further accelerate the top line and share gains versus something more reactionary or something changing in the external marketplaces forcing you to do this? Just help us understand that split and how Chewy Plus and Fresh and Frozen, this might impact the 15% incremental EBITDA margins for the business.
Yep, sure. No, it's a good question. Let's dive into it. So there's a couple of questions built into that, so let's pair them apart. So gross margin first. We're pleased with the gross margin expansion that we've delivered this quarter, right? And the drivers of gross margin, David, have remained very consistent over the past few quarters and overall in line with our story or the narrative that we've brought to the street, right? They include product mix across our merchandising-led businesses. So you've heard us talk about health, premium consumables. Now hard goods is starting to grow double-digit, albeit a smaller contribution, but still we're encouraged to see kind of where this goes. So that's kind of why we use the word product mix across merchandising-led businesses, because it isn't just pharmacy, which has continued to contribute. It is, health and wellness supplements. It's premium consumables. It's hard goods growth, et cetera, et cetera, et cetera. So Number two, so the drivers of gross margin include product mix across merchandising-led businesses, increasing Autoship penetration and scale that provides economies of scale, and our ramping sponsored ads initiative, right? So that's very consistent commentary. For Q2, the promotional environment remained highly rational, right? And we don't expect the promotional environment to be irrational in the back half of the year. So as Will mentioned in his remarks, Q2 represents the high point of gross margin for the year. And I especially want to note that gross margin will fluctuate on a quarterly basis. Right?
That helped the stock growth, but I'm convinced the company is undervalued.
This is the case.
I agree completely. They have almost a monopoly on the pet delivery, and there's so many different markets you could go down with this type of business that people aren't realizing yet, but they'll realize once it's too late.
For instance,
I was literally just comparing it to Amazon. It's literally the Amazon for pet care, and it's only a matter of time. Amazon wasn't very profitable for
the ramp of phasing
the first few years,
and sponsored ads may lead to one quarter being more meaningful
if it's anything like that, then this is a $200, $300 stock,
for 2025
and not
in general is that we plan on delivering a healthy level of gross margin
anytime in the next 10 years it could really happen as they keep
specific to 25
growing and the CEO keeps executing on stuff.
Approximately 60%
the company is very healthy financially and the model is smart. People are starting to have less kids and more pets.
So clearly,
that's exactly what we were just talking about. I have kids who cry, run around, cause issues, are aggressive sometimes. So you can have a dog which you train, he's your best friend, listens to you, every command, and it's kind of a no-brainer. I think pets are only going to get more and more popular, especially as
but we're choosing.
I feel like in the U.S. especially, like people have more money, but less time. So it's way easier to have a pet than a kid. I'll tell you that.
Incrementality is reflected in our top-line guidance, or whether it's continuing to grow Autoship stronger, or whether it's opportunistically evaluating the market in the back half and seeing if there is selective pricing lean-in opportunity. If there isn't, then great, we'll take it to the bottom line. But we've sort of left ourselves open to play the marketplace.
Would you guys take a buyout, though? I was asking earlier.
Structurally,
if let's say Amazon offered $50 billion,
so these are two different things
the share price they'll buy out at like $115. All the shares get bought out at $115. Would you take it, or do you think hold?
Certain one-time elements, but generally the ramp of our fulfillment facility.
Great, thank you very much.
Thank you. Our next question comes from Rupesh Parikh with Oppenheimer. Please go ahead.
Good morning, and thanks for taking my question. So just going back to your Get Real and some of your Fresh Frozen efforts, at this juncture, how big do you think the business can go over time? And then, I know it's early, but just any characteristics of the initial customers that you're gaining into the franchise, and in this sense, are you getting give a sense of whether you're actually getting new customers just given that launch?
Sure. Yeah. So
take it and jump to Amazon.
If we look at the TAM of the category today,
I think the same thing.
Somewhere in the $3 billion, $4 billion.
You're definitely going to have to get at least $50 billion.
The next several years, we expect this category to
it's a fair market value for a company that's debt free. And
the category
that has this much sales and this much customer growth. And I feel like Amazon could just make it so much bigger.
And that's a really healthy growth rate for us to be.
That's why you might as well split your investment between
the
two of them.
Number three, there is a lot of interest in this category from around the industry. Right? You've seen some de novo players already leaning in. You've seen national branded players start announcing their announcements or their product offerings. We're really excited to be partnering with the national branded partners as they bring their products to life in the back half of this year. And alongside that, right, Get Real, right, we expect to have a meaningful amount of share as the category grows. What is meaningful? We would consider roughly a share position commensurate to Chewy's share position in the industry to be a meaningful share outcome, right? Now, given that we've built the capacity, given that we've built the topology to be a one-day network, right, and given the sophistication that we have in our supply chain, we expect, right, the high gross margin, possibility of the vertical to efficiently translate into high EBITDA as well, right? And alongside, you asked about the quality of the customer. Let me answer that now. So far, it's early days. We've been at it, less than 4 weeks, 5 weeks. And so far, we're seeing, roughly 70% of the customers are existing customers, 30% of the customers are net new customers. And that is, as my earlier comments to Doug indicated, we'd expect that, right?
ASST.
So we're benefiting from the general traffic that the industry will create in marketing the product, and we are priming ourselves for conversion, using our site experience with Get Real. We'd expect the NetBack of this customer
I feel like any company these days that opens up a Bitcoin reserve, anything like that,
we believe they will attach
it just ends
2 or
up
3 more
skyrocketing
categories.
the
And
next
for
day.
full meals, we expect this to be,
That might be
a
the new
plus
cheat code.
$2,500 customer on an annual basis. So we're excited about it.
So yeah.
Great. Thank you for all the color. Best of luck.
Sure.
Thank you. The next question comes from Curtis Nagel with Bank of America. Please go ahead. Curtis, your line is now open. Please proceed with your question.
Hey, phone to Curtis. Take a bathroom break.
We are not receiving a response, and so I will move on to the next question, which comes from the line of Shweta Khajuria with Wolfe Research. Please go ahead. Your line is now open.
Okay, thanks a lot for taking my questions. Let me try 2, please. Sumit, could you please talk about the advertising environment, just the conversations you've had through the quarter, and what is top of mind across advertisers as we think about the back half of this year and potentially even next year, and how ad revenue is trending, or I guess advertising business, not revenue, is trending for you versus your expectations. And then the second question is generally, what are your expectations as we think about the macro in terms of net household formations for the remainder of this year and also next year? And I ask
He's
because
choking. I was about to say
inflationary pressure,
he might be having
so
a time in the bathroom with one of his buddies.
Customer
Sounds
growth
weird
versus
over there.
pricing. Do you still expect it to be, call it low to mid single digit % growth rate in the back half, or is there potential for acceleration in the back half of this year? Thanks a lot.
This is a pretty good question.
Okay, there are 3 questions there. State of the industry and key inputs, our composition of new customers and NetBack, and then 3, advertising. So let's take them one by one.
Exactly.
So in terms of the lay of the land, so let's start with pet household formation trends. Overall, the trends that we spoke about last several quarters have remained consistent, and we're not seeing notable changes relative to those comments. Right, with respect to data, the shelter channel, net adoptions remain
Today
stable,
I'm buying more
and
Chewy stacks. My price target is also 50 to 60.
And so overall,
I
we
think
expect
that's
pet
very
households
fair
to be broadly flat
valuation.
to slightly up in 2025. Right, so the point on industry continues to normalize, seems to be holding true.
Yeah.
Now, across the conversations
if you could get in under 38, which I think it
and
might dip one more time
from a consumer standpoint,
down,
we believe the back half of the year, or generally
nice,
for 2025, the industry remains in low single digit to
and then long
kind of
term,
perhaps
obviously,
the low end of the mid single digit range
it's a no-brainer
in terms of growth. And so, we are clearly taking share, growing on a 52-week basis between 7 and 8%, and 53-week basis, the 6% range or so. So, which we're excited about, and this is on top of the fact that we have tougher comps that we're comping as we move into the back half of the year. So we're excited about that. Now let's talk about our composition.
I like the CEO a lot too.
Our growth algorithm,
especially because he has the experience with Amazon,
is a combination of active customers growing low single digit to mid single digit, and NetBack growing mid single digits, right? And so we're pleased to essentially maintain that for the rest of the year. We're encouraged by the steady and consistent return to active customer growth that we have delivered over the past several quarters, and we expect that to continue on a sequential basis, right? Would remind you that we will be lapping our return to active customer growth in Q4, which will result in modestly tougher comps for us in Q4. And even with the tougher comps, we continue to expect to grow active customers at the high end of the low single-digit range in 2025, right? And then when you look at NSPAC, we delivered 4.5% growth in Q2. That is in a normalized environment, where there is some pricing benefit. Right now, there is no pricing or no material pricing benefit flowing through. So we're growing NSPAC at 4.5%, and we would expect, right, NSPAC to continue to trend in that 4.5 to 5.5%.
I got in on out of those three. I got in on Rocket Lab.
Through stronger Autoship, stronger product mix.
Let me check.
Programs like Chewy Plus that are driving consolidation.
The one issue I'm coming into is I just don't have enough money to keep investing.
Continue to capitalize on the growth that we're seeing.
I'm not frugal enough.
And then your final question on advertising. The market competitive intensity is high. We don't see generally from a lean-in point of view either suppliers nor competitive and similar returns. And so our job is to position it as the best pet membership program in the industry. We're excited about that. So there's lots in front of us that allows us to compete. Without really being concerned about competitive intensity. That's always we are observant of that, but we really obsess over our customers.
Thank you.
Thank you. We have time for one final question, and so our last question today comes from the line of Dylan Carden with William Blair. Dylan, please go ahead.
Thanks. Sumit, curious, you had some earlier comments about sort of the quality of cohorts improving year over year, and I was just wondering if you could elaborate on that. Is that just sort of simply the industry itself stabilizing and improving? Are you doing things to kind of stimulate that? And the growth, and maybe it's sort of a related topic, but the growth in Autoship and the outperformance there, which has been relatively sustained over the last 3 quarters, how long do you think that runs? Thanks.
So the quality of the cohorts improving is a result of 2 different things, Dylan, and they're both complementing us. One is the more customers we push into programs like Autoship or bring in through programs like Chewy Plus, the more our ability to keep them in the funnel, get them more opportunities we have to talk to them to get them to consolidate their NSPAC, and the faster NSPAC consolidation that we see from them. So, within the program itself, then we have worked towards improving settlement rates. So, for example, if you think about Autoship, it's a 2-sided funnel, right? We're bringing in gross subscription, and then we're retaining net subscribers. So we've improved both. Our rate of gross subscription add to Autoship has increased, and our second order, third order, fourth order settlement rates into Autoship has improved, which then means that the net retention in Autoship is much better. And you see that layer cake building pretty effectively, that continues to push a greater portion of our sales moving through Autoship. With Chewy Plus, we're seeing a similar effect, right? Chewy Plus members are engaging with and adding, on an average, 3 more categories than non-members to their baskets, right? And the mix of cohort is really interesting to us because it opens up Chewy, right, to all of the low-spending cohorts where we can rapidly consolidate baskets, and it's opening us up, for high-spend cohorts to expand and discover other products, which are also expanding basket size. So on an average, we see really strong incrementality, and the quality of cohorts of the Chewy Plus, program is healthy. Then we have a large and growing health business and a premium consumables business. Remember, every time I've talked about this in the past, we've mentioned that, when it comes to the low-end value segment of the market, which is roughly, in our opinion, 12% of the market or customers, that's likely not the place for Chewy. But everybody else, right? Chewy is the place. And then the final thing is, more and more people move in online. So clearly, online is consolidating share from offline. And, once we lock these customers in, which we were, not doing as well, in my opinion, in 22, 23, you're seeing the results sort of come through here.
Thanks. And just curious, Chewy Plus, I get that it's early days as far as sort of mid-single digit revenue penetration, but, for a lot of loyalty programs, you mentioned Prime, it's kind of the majority of the business. Is that part of the intention here? And just from a margin standpoint, let's assume it's the majority of the business. That would be margin accretive.
So look, I mean, I think we've shared this stat in the past that, at some point we did the survey not so long ago, 3/4 of our customers are Prime members, right? And so I think that's probably well understood given how broad the penetration of that program is. But candidly, what we're observing is, what we've also shared in the past is that generally it is well understood that we retain a very high percentage of our customers from going into year 2, right? And so our attrition is de minimis, past kind of a 30-month mark. And you saw that in the way that our pandemic cohorts have settled out, right? And so what happens is that once we have a customer past the 30-month mark, in the past, right, they would rapidly consolidate their share of wallet over to Chewy, right, regardless of whether they're a Prime member or not. And now with Chewy Plus, we're seeing that consolidation is happening even faster, right? With AutoShip, we're seeing that consolidation happens even faster because we've improved the proposition on the AutoShip program itself. So that was my point on, why we're seeing both accelerated as well as, credibly built NSPAC curves on the back of these two programs. And then, your other question was around margin. Yeah, we expect Chewy Plus to be margin accretive, right? So as the program ramps, obviously we're leaning into the 30-day free trial period. There's the mix of, new members to paid members. It'll take a few months for the NSPAC consolidation to start coming through. But broadly so, yes, the program will be gross margin rate dilutive, but on a dollar basis, it will be highly accretive, and on a contribution profit basis, it will be highly accretive. And so I think you would essentially underwrite a business case where if we came to you and said, hey, we're investing, X basis points, but we get 6X the return in top line, okay, I think that ROAS is something that we would underwrite.
That's pretty fair.
Yes, I really appreciate it. Thank you.
Sure.
Thank you. Those are all the questions we have time for today, and so this concludes our call. Thank you all for your participation. You may now disconnect your lines.
I feel like every company's been doing this. I do not want to listen to that music. Alright. Not a bad call, I'd say. Overall solid. If you look at everything meshed together, I think they won't have a problem in the future. I think by the end of the month even, we're going to see it at 50 a share. You just got to watch out for certain stuff. But the bottom line is they had a lot of top line growth, and the margin gains you could see were great. The customer growth is great. There's a little bit of a pullback. This was good, bro. Appreciate it. Appreciate you. We got the same name. We're both Dan. So I'm gonna be doing a lot of earnings calls and stuff. If you want to subscribe and stuff, and I'm gonna try. I've never really done I used to have a YouTube channel that was similar kinda, where I did stocks and stuff, but it ended up getting deleted for copyright. So I'm just getting started again, and I'm kind of starting at zero again. So it's nice to see you in the chat. I appreciate you being here as well, and we're gonna keep grinding and checking out all these stocks, and hopefully we have a great rest of the year, and next year as well. I think we're gonna have a great year. I think a lot of people were at the start were worried with the Trump the party, but I think we'll be fine. I think there's not too much to worry about. Obviously, there's gonna be bumps. It's a roller coaster like life, but we'll be fine. Subscribed? I appreciate you, brother. All right. Yeah, I'm probably gonna end the stream here too. I don't want to really wait till market open. I haven't eaten breakfast yet, and I got a lot of accounting stuff I gotta do because I'm still going to college. But I appreciate you being here, Dan, and anyone else who was here. Have a great rest of the day, and Chewy's looking great. I'll tell you that. Do Adobe tomorrow. When's Adobe? Let me check. Adobe stock earnings call. Earnings. Oh, aftermarket. Yeah, I think I could do that. I think I could do after. Yeah, I want to do all the big ones that I know, all the ones that I've been looking at or I have positions in. That's kind of what I'm gonna do. So at least 3 to 5 times a week. Obviously, I'm not gonna do every company. I would probably lose my hair doing that. Already losing most of it, but then I'd lose the rest. But all right, guys. I appreciate you being here. Have a great rest of your day. If you wanna drop a comment after I'll publish this as a video, and I could respond back to you guys. And thank you.